Hi, my name is Shadrach Frempong, and welcome to today's video on accounting concepts and policies. So, accounting concepts are the assumptions which are used in preparing and disclosing items in the financial statement. They refer to all the assumptions that underpin the preparation of financial statement. Now, there are a lot of assumptions out there, right? But the ones that is being adopted by the management of an organization in preparing their financial statement becomes the accounting policy of the company. So basically, accounting policy has to do with the specific accounting principles, accounting basis, accounting conventions, accounting rules, and accounting practices, which is being applied by an entity in preparing and presenting its financial statement. Example has to do with depreciation method and also valuation of inventory, value of inventory. When it comes to depreciation, we have the straight line, we have the reducing balance method. Reducing balance method. Management of a company may decide to use the straight line rather than the reducing balance method. So if that is the case, then the accounting policy. Let's look at some accounting concepts, and the very first one we're looking at has to do with the going concern concept. So this concept states that the entity will continue to be in existence into the foreseeable future, and in preparing the financial statement or the account of the company, that is one of the assumptions the accountant makes, and this assumption is that the company will operate for an indefinite period. By so doing, the balances are carried down to be used for the next period. A classical example has to do with an asset which is being shown at cost or at net book value, or carrying amount, right? So anytime you see a financial statement and the asset is being recognized at cost or net book value or carrying amount, indirectly what they are telling you is that the company will be in going concern. The company will operate for an indefinite period, or the company will continue to be in existence into the foreseeable future. So in the absence of going concern, assets are shown at liquidation values. So if the company will not be in existence into the foreseeable future or will not operate in an indefinite period, the company is not supposed to use the cost or the net book value or the carrying amount, but rather they will be using the liquidation values. 2. Accrual matching concept. So this concept states that expenditure for a given period, whether that particular expenditure has been paid or not, should be matched against the revenue earned in that same period when we want to determine profit for that period. So basically, what this concept is saying is that in order to determine profit, we should match revenue against expenses. And this is using the accrual base of accounting. When it comes to revenue, the moment we have earned that revenue, we are entitled to that revenue, then we should recognize that revenue, right? So the moment you're entitled to that revenue or you've earned that revenue, we should match that expenses, whether that expenses has been paid or has not been paid in that period, it should be matched against the revenue, so as we'll be able to determine our profit for the period. Let's move on to the next one, consistency concept. So this concept assumes that the accountant should maintain a specific method of recording accounting transactions of a period. Although there are many methods which can be used, but for the purpose of comparability, which is one of the qualitative characteristics of a financial statement, we are saying that one method should be maintained consistently, and anytime a method is changed, it should be disclosed in the way of the note to a financial statement. So basically what we are saying is that if the accountant or management decides to use straight line method, then they should be consistent with this method and not using straight line method this year. The following year they use reducing balance method. Another year they come back to straight line. They move to reducing balance method. This concept is saying that if you think straight line is what you'll be using, then please be consistent with it. The same thing happens to inventory valuation. If you feel weighted average is going to be most suitable for you, then use the weighted average method. However, going forward, if you think there is a need for a change, then you can change the method that you are using and you disclose it in the note to financial statement that there has been a change in, let's say, the accounting method or the inventory valuation method that is being used. Move on to the next one, prudence. So this concept forbids the accountant from anticipating profit, but requires the accountant or requires him to provide for all possible losses. We are saying that where losses are foreseen or it is being anticipated, then we should take it into account immediately. The principle is that provisions are made for liabilities and expenses, whether the amount is known with certainty or it is the best estimate at the time. So even if we don't have the exact amount, we can anticipate the amount and recognize it in our books. Another key takeaway is that revenue and profit are not anticipated, but we have to wait till the revenue or the profit is being what? Realized. And realization in this sense means that where there is a reasonable certainty of what? Receiving the cash or other assets. So in summary, revenue and profit are recorded only when it has been realized, whilst expenses and liabilities are recognized as soon as they are anticipated. And this is one of the concepts that actually protects potential investors. If not for this concept, then the financial statement that is being prepared by most accountants may not show the true picture or what's actually happening on ground, in the sense that in the attempt to convince a potential investor to invest in the company, they would like to anticipate some revenues to show huge amount of profit, which is tend to convince investors to invest in the company. If this revenue are being anticipated, the investor may think the company is a profitable venture, whilst the reality the company might not. So this concept is saying that don't anticipate any revenue, don't anticipate any profit. Rather, anticipate or make some provisions for all expenses and liability. That is to tell the investor that, listen, after you have invested in the company, these are some of the liabilities that the company may be facing. And after you have invested, your money will be used to settle some of these liabilities. So it is important to disclose all liabilities and expenses when it is foreseen. So let's move on to the next concept, the business entity. So this concept is what the legal guys call the separate legal entity. And basically what it means is that the company is seen as an artificial person which can sue or be sued in its own name. So we can sue the company without suing the owners of the company, because the company is seen as a separate person and the owners are also seen as a separate person. So they are two people, even though more or less the owners own the business. They are two people and both of them can be sued and be sued in their own name. We have a similar concept in accounting, and that is the business entity concept. So basically what we are saying is that when it comes to preparation of the financial statement of the business, because the owners of the business are seen as a different person from the business, then the personal transaction or affairs of the owners should not be recognized in the financial statement or in the books of the business. The business has the ability to generate its own revenue and incur its own expenses, and that is what it should be used in the preparation of the financial statement, whilst the personal transactions of the owners of the business should not be included. So the financial statement should be solely the transaction that has transpired between the business and other parties. So we move on to the next one, the money measurement. So money measurement, we are saying that transactions are recorded in monetary terms, and therefore all components of the financial statement are expressed in monetary terms. So basically what we are saying is that all items in the financial statement or all transactions that is being captured in the financial statement are items of monetary value. They should have some value assigned to it. If there is no value, then it cannot be captured in the financial statement. Periodicity. So what we are saying is that the life of an entity is divided into a short-term economic period on which reporting statements are fashioned. So example has to do with the financial statement which is being produced or prepared at a regular interval. So mostly the financial statement is prepared to cover a 12-month period, and it's because of what? Periodicity. Dual concept. So the double entry accounting system requires all transactions to have two entries, one on the debit side and one on the credit side. I'll be making an extensive video on the dual concept of accounting. So kindly pardon me because I will not be going deep into it. Realization. So this concept holds the view that profit can only be taken into account when realization has occurred. So generally sales revenue arising from the sale of goods is recognized when the goods are being delivered to the customer. So basically what we are seeing is that when it comes to recognition of revenue or even profit, we should earn that revenue. And you earn that revenue by fulfilling your portion of the contract. Example has to do with a sale and purchase agreement where you have to sell goods to your customer and your customer pays you. The moment you deliver your goods to the customer, you have fulfilled your portion of the contract and you are now entitled to the revenue. So in that case, that sales revenue has been realized even though it has not been received. Materiality. An item which are significant enough to affect the evaluations and decision making must be disclosed in the financial statement. And an item is material if its disclosure or non-disclosure will alter the view that may be expressed on a financial statement. So what this means is that an item is only material if it's going to affect the decision that you as a user of the financial statement will make. Example, you have been presented with a financial statement, then you realize that the financial statement has an omission of, let's say, $1, right? You would still go ahead and make your decision anyway. You still go ahead to analyze the financial statement and come up with your decision. But in the case where you were analyzing the financial statement and you realize that there is an omission of, let's say, $1 million, then you would say, listen, there is too much of omission in the financial statement and I cannot make my decision based on the financial statement that has this omission in it. What it means is that this $1 million is material. It is material in the sense that it is going to affect the decision that you are going to make. Ordinarily, you are just making an analysis. But when you saw this omission, you are like, this omission is too much. And I cannot make an analysis on a financial statement that has this huge omission in it. So it makes that $1 million material. Now, when it comes to issue of materiality, it depends on the company. So as an auditor, anytime I go out to audit a company, we set our materiality level. You will find out that for a particular company, you will find out that $1,000 is material for some businesses, while some other businesses too, 10,000 might not be material. So the issue of materiality actually depends on the company in question. Let's look at substance over form. So substance over form is that transaction and other events must be accounted for and presented in accordance with substance and economic reality rather than its legal form. So the key takeaway is that what is the reality? We are not concerned about its legal state. So a classical example has to do with a tax authority going to an unregistered business for their taxes. And the management of the company says that, listen, we are not a registered company, so therefore we are not supposed to pay taxes. So the economic reality is that they are doing business. Even though they are not registered, that has to do with the legal aspects. So applying the substance over form concept to this scenario, the economic reality is that they are doing business and they are generating revenue, they are making profits, even though they are not registered. And the tax law of the land requires that anyone who is making profit or who is doing business is supposed to pay taxes. So we are not going to consider its legal aspect, but we are going to look at the economic reality, what is happening on ground. Disclosure. So the financial statement of a firm must include information necessary for formation of valid decision making by users, and any information that might be relevant to an investor or creditor should be disclosed either in the body of the financial statement or in the notes attached to the financial statement. So we are saying all information that you think is going to be relevant to your stakeholders as an accountant or as a business. Those information should be disclosed or should be included in the financial statement. If it is not in the body of the financial statement, which is the income statement, balance sheet, cash flow, or changes in equity, then you should disclose it in the note to your account. Thank you for joining. If you have any question, just put it in the comment section. We will meet in some other video. Make sure you subscribe so that anytime I post another video, you get a notification. Thank you.